Hey, what's up, everyone? Welcome to another week of the Wealth Webinar Wednesday series. My name's Stephen Nagy. I'll be hosting the show today along with my partner Craig Yenny and the director herself, Shauna Decker. So, what's up, Craig? What's up, Shauna? How are you both today?
Doing pretty good. Good to see you, Stephen. Glad to have Sean on here as well.
Yeah, I'm happy to learn a lot today about loans and how they work.
Yeah, absolutely. All right, so we're going to dive into this. If this is your first time on Wealth Webinar, we do this every single week, a different topic on financial education, all about taking back control of your money and solving your money problem. Today, we are going to be focusing on one of my favorite topics to talk about, which is becoming your own bank, and specifically how we do that using the infinite banking concept. So we're going to start out. If you've been coming to these wealth webinars for a while, you might know some of the basics. Maybe you've watched one of our famous 90-minute infinite banking training videos that kind of walks you through the whole mindset, the process, different case studies and examples of how infinite banking can be used. But what we're going to do today is we're going to spend a few minutes just kind of setting the stage, about 10 minutes. What is infinite banking? And then we're going to dive into, like Shauna just mentioned, really spend some time talking about loans, how loans work with infinite banking, some different options, and how we can start using loans for various strategies depending on where we are in life. So let me just start the stage real fast. What we're going to do is we're going to talk about a few different topics. So let me ask this question next. How many of you might have some debt in your household? So this could be credit card debt, this could be student loan debt, this could be lines of credit debt. But how many of you have debt in your household? I'll just share a couple things I was researching last night. So this is from the Federal Reserve Bank in New York, but this was just released with Q2 data. I know we're getting ready to wrap up Q3, so we'll have new data coming out next month. But we look back to Q2 of 2025, household debt reaches $18.39 trillion dollars, including auto loan originations increasing. So total debt increased $185 billion dollars to hit 18.39 trillion in the second quarter. Mortgage balances grew by 131 billion, totaling 12.94 trillion at the end of June, and auto balances also increased, rising by 13 billion to 166 trillion. Another interesting statistic I found real fast that I just wanted to share with everybody is credit card usage. So debit balance in credit cards in the United States increased to $1.21 trillion dollars. Now, Chris and I do a show each week called What the F Happened, and it's where we dive into the news, what's going on in the United States, in the world, in the economy, and just what the F sometimes, because how many times do we say that when we read a news headline these days? But we've been talking about credit card debt for couple of years now. And I remember just last year when for the first time in history, it eclipsed $1 trillion dollars. Well, now we're sitting here, and this is looking at again, second quarter of 2025 data. It was 1.18 trillion in the first quarter, and now we're up to 1.21 trillion the second quarter. So we'll see where the third quarter comes in. But if the trend continues, it continues to increase. And we can look back, going back, looking at this graph right here. If we look back over the last 10 years, you can see how credit card debt is definitely starting to increase, especially here in the last couple of years. And if we scale back, it's not like the max, but if we scale back, you can see similar to 2008, 2006, 2007, you started to see a lot of debt, a lot of credit card debt, things of that nature. 2008 hit obviously a lot of bankruptcies, a lot of delinquencies, a lot of foreclosures, all that debt came crashing down. And so we understand that that is a challenge and that's an issue for people. So that's what we're going to focus some time on today is how can we solve that problem for you? Because like I said, that's what Wealth Webinar is all about. What is your money problem and how do we take back control of our money to solve that problem? So let me ask this question. How many of you that said you're in the debt bucket, how many of you would think it'd be valuable to spend your time with us today if we can show you how to eliminate that debt faster while still building wealth? Now, if you're not in debt, don't worry. We got more for you on today's show. So we're also going to get into buying cars. How many of you have purchased a car or plan on purchasing a car within the next, let's say, 12 months of your life? All right. Because at the end of the day, there's a few different ways to buy cars. There's cashing, there's buying a car with cash, there's leasing, there's financing, or there's another way to buy cars, which is using your own banking system. But how many of you would like to see how to get back every dollar for every car you'll ever buy, drive, and own for the rest of your lives, starting today? So then from there, and I'm going to hurry up because we got a lot to get into, but from there, we're going to start getting into the person that is building wealth, the investor. So how many of you are at the point in your lives where you're building wealth? You're looking at retirement. You're trying to grow your wealth. You're trying to plan for that time in the future. Maybe you're doing real estate investing. Maybe you're doing private money lending. How many of you are controlling your investments, not just blindly throwing it into a 401k or your financial advisor? I'm just curious if you're actively investing your own wealth right now. Maybe you're investing in a business, your own businesses. That counts as well, because we're going to talk about that. We're going to talk about the investor. We're going to talk about the person that borrows money for their business and what that looks like, and how you can use your own banking system to actually fund your own businesses, to fund your own investments, how you can have that same dollar that you earn grow for you multiple ways at the exact same time. So we're going to get into that with you today. And then finally, we're going to close out today's webinar talking about the retiree. So let me just ask this question. How many of you, let's say in the past, I don't know, or not in the past, but let's say how many of you in the next 3 to 5 years are planning to quote unquote retire? So Craig, it looks like we got a little bit of everybody on the show here today. So I know that was a lot. I know we got a lot to cover. This might turn into a 2-week episode. I don't know, but we're going to cover it. So if you guys have any questions throughout today's webinar, throw those questions in the Q&A box. We're going to answer them as we go. When I'm talking, Craig will be answering. When Craig is talking, I'll be answering. And Shauna's going to look there and be her normal director self and make sure things are going smooth. So we're going to have some fun here today with everybody. But you guys ready? You guys ready for this? Craig, anything you want to add?
Yeah, I think that was great. And, one of the things I saw some of the comments is some of the people are multiple of these categories. Some people are in debt, maybe retiring, in debt, buying a car. So there's going to be some bleed over, but yeah, I think we have a great mixture today on the wealth webinar for us.
I love it. I mean, I'm right there myself, Craig. I'm buying cars all the time, it seems like, and whatnot. I'm investing in growing wealth through businesses. I am investing in things like private lending through real estate deals. Maybe you could show me how to use my banking system to buy a non-gray hair formula. But we're just having fun with you guys. So, all right, you ready to dive into this, Craig?
Let's do it.
All right, so I'm going to do something. Like I said, I don't have a board to draw on, so we're going to do something a little bit different today, and we are going to take some live notes with everybody. So how many of you, I guess I could do it even old school, just write the notes down. I mean, does anybody still carry pads of paper with them? I mean, I always got mine with me. I always want to write things down. So if you got a pad of paper, get it out, get ready to write down. If you're taking notes on your computer, that works as well. But what is BYOB and IBC? And Craig, feel free to throw stuff out here and I'll continue to type stuff down. So why, and we'll talk through this stuff as well. So why do we want to become our own bank, and why do we want to practice the infinite banking concept, and what does that mean? Like, what does that mean to be able to do that?
Yeah, and I think the other question you could throw in there is, how do we finance the things we buy throughout our life?
Okay, so let's start with what is BYOB and IBC. So BYOB obviously is be your own banker. So let me ask this question to everybody in the room right now. What do banks do? Like, what is the purpose of a bank? All right, so banks are to me, a bank is a warehouse of wealth, because what are we doing? We go there and we put our money into the bank. Okay, it's pretty simple, right? And then what do banks do? Banks take our money, and what do they do with it?
Looks like they're loaning it, they're investing it. Shauna says they're doing it without even asking us. So Shauna, they don't call you up and say, hey, Shauna, Steven wants to take a car loan. Can we use some of your money to do that?
Right.
Yeah, and I'm going to switch back and forth from notes to do a couple different screens, just so we can really make sure you guys are following this. Okay, so what we want to do is, if we want to become our own bank, we want to start mimicking what banks do. So, like we said, we're going to take our money, we're going to put our money at the bank. They take that money, they don't lock it away in a box somewhere. They're going to take our money and they're going to immediately do what? They're going to get that money moving. They're going to have that money immediately start going out there making more money for the bank. This is how banks operate. Now, banks have an advantage because they get to use things like fractional reserves and things of that nature, so they can lend out a lot more than they already have. But we're going to start mimicking that with this banking policy through what's called compounding uninterrupted growth. And we'll get to that in just a minute. But let's start with the banking principle. So how does the machine operate? How does this banking system work? So like I said, we take our money, we put it at the bank. Let's say the bank gives us a 4% return within our checking or savings account. Well, the bank's going to immediately take that money and start lending it out. So banks do things like lend it out to somebody that wants to purchase a home. Well, let's say I go to the bank and get a mortgage, get a stack of money to go purchase a home. I'm going to take that money, I'm going to give it to the home seller. The home seller is going to take that money. What are they going to do? They're going to put it right back into their bank account. So the bank is simply creating a circle. So I can't draw a circle on this digital note, but if you're taking notes on a notepad, draw a circle right now, okay? Because a lot's going to deal with the circle of wealth, the circle of how money moves. So draw that circle. But banks do more than just lend on homes. Bank lend on auto notes quite frequently. If you want to get a new car, typically you go to your bank. If you want to remodel your house, you can get a remodel loan. People take that money, they give it to a contractor, same thing, right back to the bank. So you can see in each one of these scenarios, that money is just going in a big circle for the bank, with the bank being the center of that circle. Debt consolidation, you go get a personal line of credit, a debt consolidation loan, something like that. You take that money, give it to the credit cards put it right back into the bank. So it's just this circle. But at the end of the day, what is the bank actually doing? Well, the bank is making a spread. They're taking your money, they're offering you a certain rate, and then they're lending that money out at a higher rate, and they're going to make what's called a spread. So in a home note, quite often they'll make around a 3% spread in this case right here. On a car note, the interest rate's a little bit higher typically than a mortgage, so they're going to make a little bit higher of a spread. A home remodel loan, usually uncollateralized. There's no collateral in a home remodel loan quite often, unless it's like a HELOC type loan in which maybe the home does have a second lien on it, but typically a higher interest rate. So they're going to make a 5% spread off that. Debt consolidation, again, an uncollateralized loan to you, or a personal loan, so higher interest rate. So maybe they make a 12% spread, but they're still paying you that same 4%. So if we do the math right here, they made 3% off the mortgage loan, 4% off that car note loan, 5% off that home remodel loan, 8% off that debt consolidation loan. They just made a total of 20% off of your money. Although it's actually a lot larger than that, because if we actually understand math and we do the math on this, what are they actually making off of us? Think about it. If they are paying us 4% and they're making 20% on the money that we're sitting at the bank, what is that really equal to be? 500%, right? It's 5 times what they are paying us in interest. And in fact, we do a lot of research. So I want to give you guys some resources today too, to go look up after this webinar. So if you go to a website called bowerfinancial.com, you can read all these reports and different studies that they do on the banking system. And they tell us that banks make between 400 and 1,300% off of money that you leave at the bank. All right. So I asked the question before, and I'm going to switch back to the note page now. Why do you want to be the bank? Well, if we know banks are making 400 to 1,300% off money that we leave there, wouldn't it make sense for us to start keeping some of that money? Craig, doesn't that make sense to you? Instead of giving all that interest, letting banks make all that money off the money we're sitting there, what if we just became the bank?
And I think one of the first steps we want to talk about is, why are the banks able to do that? Well, that's because that's where we're putting our money. That's where we're storing it. You get a paycheck. Where does it go? Goes in the bank. How long do you leave it there? Well, until you pay bills out of it. Or you move it into a savings account, and they're doing the same thing with your savings account. So the
Absolutely.
question is, what's the first thing you should do? Put your money in the bank or your own bank?
Exactly. And that's the question that you're going to hear us ask time and time and time again. All the one key to all of this is making one change in your life, and that's where your money goes first. So I'm going to write that too, because it's very
And,
important.
and
Where
didn't
your money,
Shakespeare say something like what Sean had just mentioned, leverage yourself or be leveraged, to leverage or not to leverage? That's the question.
yeah, yeah.
I don't know. Maybe it wasn't Shakespeare.
Some smart philosopher, right? But where your money goes first. So change one thing where your money goes first. Instead of going into somebody else's bank, it goes into your banking system. Sure, you can store your money under a mattress or bury it in the backyard. I mean, they say Miami was built off of drug money, and you go to the backyards of Miami and there's hundreds of millions of dollars buried in the ground. But is that the best strategy? Typically not. So let's be smart with our money. Let's be smart what we're doing with it, and let's grow our wealth while we're simultaneously doing nothing different. And that's why one of my favorite things to say about the infinite banking concept right here is we're not working any harder, we're not working any longer, we're not taking on any more risk. We're changing one thing, and that's where our money goes first. And when we change where that money goes first, it's going to allow us to do everything else and become our own bank. And then from there, you're going to see exactly how we're able to do what we do. Now, Craig, let me clarify, because when it comes to being a bank, we're not actually starting like a community bank. Okay. Is that fair to say?
I think it's very fair to say because that's a lot of work. You have to get a charter, you have to get the money. I mean, there's a lot involved with actually creating your own bank.
Yeah, Chris and I have been looking into it, and it's a lot of stuff going on to create a bank. But the good news is we have tapped into a strategy known as becoming your own bank that's been used now for almost 200 years and was made popular by a guy, I don't know, back in the 90s, Craig, I guess it was, named
Hmm.
R. Nelson Nash. So again, I'm going to give you guys some resources here. R. Nelson Nash. So start with the book, Becoming Your Own Banker. I would recommend the Audible version, but also getting the hard copy version because there's a lot of illustrations in the book that you can read while you're listening to the audiobook. But that's where you got to start. So if you are somebody that wrote new on here, after this webinar, go find this book on Amazon, out there on the internet. You can download it, but go check this out because that's where you're going to want to start. See, what we're teaching is nothing necessarily new. We've taken a strategy that's been around for almost 200 years that Nash has been teaching to thousands of people all over the country since the 90s. Since there's been books written about it, things like what would the Rockefellers do? This is exactly what the Rockefellers, how they've been able to create, how they've been able to not lose their generational wealth and how they keep the generational wealth going over and over and over. Unlike people like the Vanderbilts who have lost a lot of it, the Rockefellers knew what they were doing. So what would the Rockefellers do? Excellent, excellent book on this exact same concept. So this is stuff we've been doing. See, what we teach has been around for a long time, but what we do is we put a new little spin on it. We're using modern technology. We're using data-driven approach to show you exactly how to do this. So before, when I mentioned how many of you would like to pay off debt quicker while still building wealth, how many of you like to get money back for all cars, how many of you would like to build wealth, multiple ways with the same dollar? When I ask that stuff, all of this is capable and possible because of this right here. So let's talk about what this is. If it's not an actual bank, what is this bank? What
But
is this vehicle
one quick
that
thing,
we're going to use?
Stephen.
Go
So
ahead.
you've got the debt, talk about getting the money back for the cars we purchase, having opportunity funds. But wouldn't it be cool if you could do all of that throughout your life, and then when you get to retirement, have, supplemental retirement income from your own banking system? So I think that's the full circle as we get rid of the debt, we use the system to finance the things we need and want through our lives. We build more cash flow with opportunity funds. And when it's all said and done, we have a resource or an asset that we can use for retirement as well. So to me, that sounds pretty cool. And so let's figure that out.
Absolutely, man. And we call it the and asset, because it's not, so many people are like, well, I'd rather go invest in the stock market than do this, or I'd rather go, buy this real estate as opposed to do this. But it's both. Or I'd rather pay off debt than have to worry about planning for retirement yet later in life. But it's all of that and more. Like we can do all of that because again, guys, we're changing one thing where our money goes first. That's it. We're not doing anything differently, except we're going to start using our own banking system instead of somebody else's bank. Now, and the way that we do this, we're able to pay off debt, get money back for cars, build wealth, and have that retirement income later on is by changing that one thing. And that one thing is built off a whole life insurance policy. What we like to call especially
It'll spell correct for you.
yeah, designed and engineered. So you want to talk a little bit about that real fast? Craig?
Yeah, so I'm sure there's a lot of people out there that, oh my goodness, did you just say whole life insurance policy? I'm out of here. But
Yeah.
this is not the whole life insurance policy that you're going to get if you walk down the street to your State Farm agent, or a lot of time we talk about this fictional person, your broke ass brother-in-law. But these policies are specially designed and engineered, almost like, think about if you're getting a suit coat or a jacket built. I mean, we're going to tuck it in, pull it in. We're going to figure out exactly, is this a business coat? Is this a tuxedo? What is this? No different. We're going to take your goals and design a policy around how is that policy going to help you solve your goals, whether that's debt, whether that's used for financing or for opportunities, retirement, all of that stuff. But why do we say it's specially designed? What is the ingredients? Well, we're taking your premiums and we're building it to where it builds high cash value immediately. That's the key, because traditionally designed whole life policy, you might put in thousands of dollars and then 3 or 4 years later, you might have a little bit of cash value accessible. That's not what we do for infinite banking. That's not how we design it. So that's the big piece to really understand, is this is going to be specially designed for high cash value, typically minimizing the death benefit portion of the policy.
Yeah, exactly, Craig. And just to clarify, you mentioned premiums, and I want to say this because it takes a little bit of a mindset shift to fully grasp what becoming your own banker is really about. And that's why I always recommend go read the book, go listen to the audio book, go read What Would the Rockefellers Do, go read the different various resources, watch Chris's YouTube videos, watch the trainings that we put out, but really like surround yourself with it for a couple weeks, for a couple months, whatever it takes, because it's like riding a bicycle. As soon as that clicks and your brain starts to understand what's actually happening, you'll never go back to the old way. But it does take a mindset shift. So when we say premiums, it is the premium that goes into this whole life policy that is driving this entire thing. However, if we're a bank, okay, I'm taking my paycheck and I want to deposit and I want to put that into the bank account. What am I doing? I'm not paying a premium into my bank account. I'm depositing the money into my bank account. So if we're not using a typical whole life policy, if we're building what's called a specially designed and engineered BYOB policy, well, those premiums are no longer, they're still premiums, but from a mindset perspective, they're really deposits. Because like you said, Craig, the money that we put into a whole life policy and the way a whole life policy works is there's a few different things that we need to understand about one. And I'm going to pull it up real fast, Craig, because I want to show this real fast.
Okay.
You guys got to understand what these policies look like to understand what's going on here. So up on the screen right here is what we call an illustration. Okay. So this illustration is basically showing how your BYOB specially designed whole life policy is going to operate. Now, this was for a 40-year-old female. And so yours is going to look differently. Every single policy that we design is different. There's never one that is exactly the same, because every one of our clients have different goals, have different problems that we're solving. And we're going to build this policy, this illustration, to fit specifically your specific needs and who you are as a person. Okay. So I'm going to be very clear about this. So this was a real estate investor. This was a young lady that I was working with out in the northern Pacific region of the country, and she was doing real estate flips. Okay. And she had a policy that she wanted to put $150,000 into year one. Okay, so you'll see contract premium. Again, what is this really for us though? It's not premium. What is it? I just said it. What is it, Craig?
Premium deposit.
They're deposits, okay? Because again, this is our banking system. So this is our deposit. So each year, this is the amount of money that we're going to put into this thing. Now, I want to be very clear about this. That premium, that deposit that you're putting in, you're going to decide upfront how much goes into it each year, okay? So you can put in a few $100 a month, you can put in a few $100,000 a year. It's completely up to you, anywhere in between. It's whatever you're comfortable with and you qualify for. That's it, okay? It's up to you. And then that premium or that deposit that you're putting into that policy, there's a lot of flexibility in it as well. So you can put into it monthly, quarterly, biannually, or once a year annually. You can do those premium deposits into the policy, and that can change over time. So you have a lot of flexibility on the mode of payment. Also, the amount of your premium deposit can change over time as well. So there's going to always be a ceiling for how much we can put into it, as a maximum each year, and a floor, how much we can put into it as a minimum each year. And depending on your financial situation, we can build this to give you that flexibility. So in this case right here, just to give you an example, she has an ability to put in up to $50,000 in this thing every year for the first 10 years. Or if something happens to her financially, she can lower this down below $18,000 a year. So her ceiling on this policy is $50,000 a year. Her floor is about $18,000 a year, a little less than that, okay? Now, if she wants to start doing more above her ceiling, well, that's when we start opening up additional policies and growing your banking system, just like banks do by opening new branch offices. When banks want more money to lend out so that bank can grow, what do? They open branch offices to attract more customers, to give them more money so they have more money to go out there and use. Same thing with our own banking system. We're going to open more policies for ourselves, for our spouse, for our kids, for our family, for our immediate family, a family banking system. And that's what we've talked about in past wealth webinars, what that family constitutionality is. But let's focus on today. Okay, now there's other buckets within this whole life policy that you need to understand from the start, okay? So there's what's called cash value. So cash value in every one of these policies is the amount of money that's available to use, okay? So just to give you an example, she puts $150,000 in the first year into this policy. How much does she have available to use? $132,000. Now, is that 150? No. She does not have all of the money available that she puts into it immediately in year one. Okay. Now, is this a lot more than a standard whole life policy? Absolutely. A standard policy, there'd be no cash value typically for the first, I don't know, 6, 7, 10 years. So this is in year one, within 30 days, she's going to have access to this. Okay. But it's not 150. Why? Because there is cost to have these policies. But remember, cost is only an issue in the absence of value. So let me show you the cost. So the cost in year one is about $18,000. Okay, but let me show you how quickly the value of this overcomes that initial cost. And if you're okay with giving up a little bit in the early years for huge life-changing generational gains in the later years, then you're in the right place. And I'm going to show you how that works in just a second. Still following, Craig? We good?
Yeah, it's all good.
Okay.
I'm just kind of watching the comments. And if you do have any specific questions, I know there's a lot of stuff scrolling through the chat. Make sure you put them in the Q&A so we can address them. And there are a few things we can get to here in a moment.
Okay, cool. Yeah, I'm almost done with this. I'm going to pass it over and we'll get into it, Craig. So the death benefit is the other area I wanted you guys to be aware of. So the death benefit is what's paid out to your beneficiary tax-free upon your demisal. Upon your passing. So that's kind of like the cherry on top, because we're not using the death benefit. In fact, what happens with the death benefit actually is when we do use the cash value, it comes out in the form of a loan. That's how we're able to do, put the policy in, put our money into our banking system and use it for all this other stuff we're getting ready to show you. It's because the money comes out via a loan, and that's what allows it to come out tax-free and all the benefits that we have by having this policy. And basically what's happened is the insurance company is using your death benefit that they know they're going to have to pay out to you one way or another in the future. They're using that death benefit as collateral. And that's why they're able to give you that loan of that cash value to use. So this cash value, you can see in the early years is a little less, but look at the third year, what happens. The third year of this policy, you put in $50,000 and the cash value grows by over $50,000. So in the third year of this policy, this is what we would call an annual cash on cash efficiency zone, meaning every single year now for the rest of our lives, as we put premium deposits into this policy, our money's going to grow within that policy more than we put into it. Look at that. I mean, in the 10th year of this policy, we put in $48,000 and the policy grows by $72,681. At the end of 10 years, we had put in $595,000. We have $673,000 available. And you'll see it just gets bigger and bigger and bigger and bigger as time goes on. 15 years, we put in 683,000 total. We have $922,000 available. So there comes a point where this is later on where we're going to start looking at using this huge cash value growth for that supplemental retirement income that Craig talked about. But before we get there, in those early years, what were we using this cash value for? We're putting our money into this banking system instead of somebody else's banking system that we're immediately pulling out to use it things for. And that's what we're going to show you right now. That's what Craig's going to get into to show you how we can use it for debt, buying cars, investing in businesses, investing in real estate, and then we'll get into the supplementary retirement. So Craig, what do you think?
Yeah, I think all that's great. And we have a few questions I think we need to address. And one is, so Stephen, you're showing some big numbers there, 150,000 dump in, 50,000 a year. Could this be done with $1,000 a month? Could it be done with 500 a month? Could it be done with no dump in?
Absolutely, 100%. My first policy was $6,000 a year, and I was paying into it $500 a month. Shauna, what was yours? Do you remember?
It was about the same, $5,700 a year.
Yeah, what we recommend to make this make sense for the policy, for the banking policy, we recommend that you put in at a minimum 10 times your age on a monthly basis. So if I was starting fresh right now, I have some debt, I don't have a whole lot of savings, I don't have a whole lot of extra money available each month. I'm working hard, but don't have a whole, I just want to be smart with my money. I would want to put in at least like $430 a month. Okay. If I'm 43, $430 a month, or hell, I'm 42. So $420 a month is what I want to put in at a minimum. Okay. So however old you are, just times that by 10 on a monthly basis, and that'd be a good starting point. Now you can put more in, obviously, if you want to, and we can have a flexibility zone in there for you, but that's what you're looking for. And then the other thing I'll mention is you saw the 150 up front of the 50 a year after that. We can also do a larger amount up front. So maybe you're comfortable saving and putting $500 a month into one of these policies, but you just cash something out. You just sold something. Maybe you have money sitting in a savings account not doing anything for you. You can take that money, you can dump it into the policy. You can front load that policy. I like calling it a dump in. You can dump it in that policy immediately up front and then do the smaller manageable amount moving forward into the future. Whatever you're comfortable with. But you get that money in the policy. Now, again, once the money's in that policy, what's it doing for you? It's compounding and growing tax-free, guaranteed, uninterrupted for the rest of your life. And that's where the power of that policy becomes. And then we simultaneously start using the strategy called the infinite banking concept to start using it the way Craig is going to show you. So I apologize for those large numbers. That's the one illustration I just had pulled up and ready to go. But yeah, we can show you these numbers, scale it bigger. We can scale it smaller. The numbers are going to be the same.
Yeah, and I think there are just some other questions about, what are the maximums? So there's a lot of things to discuss are in terms of human life value, which is looking at your gross income, your age brackets, how much death benefit can you have on your body. There's all of those things that can come into consideration. But when people say, how much should I put into this policy? It really depends on what you're trying to accomplish. And we have a team of people that will meet with you and have those in-depth conversations so we can understand your cash flow, your situation, how to design a policy just for you. So there's a lot of situational things that could depend on, why we design a policy a certain way or why we're putting in money, why we're doing dump ins. So that's really where having a strategy call with one of our mentors would help you understand that.
Yeah, absolutely. And I just put that link over in the chat
Yeah,
box. If
gotcha.
anybody does want to schedule a call, that's exactly what they're going to do with you. I'd recommend a Zoom call. And don't worry, the mentors all speak a lot slower than I do. I just know we have a lot of information we're trying to get through here today. But schedule that call. They'll do a Zoom with you. You guys can see each other. If you prefer a phone call, that's fine.
Well, let's jump into a few things because
Awesome, Jason.
what we want to talk about today is how do you take loans? How do loans even work? And then we want to talk about a topic that comes up often, and I just want to get that addressed today is, hey, if I'm using my own banking system for debts, when should I pay my policy back? If I'm buying a car, when should I pay my policy loan back? If I'm an investor and I'm using my money for opportunities, when should I pay my policy back? If I'm in retirement and I'm using the policy for supplemental retirement income, when should I pay my policy back? So there's all these different situations. So let's spend the rest of our time running through that. But before we get to that, I just want to review how a policy loan works. I'll run this in slideshow mode. So this is our kind of one of our disclaimers. I know everyone that came in clicked on a disclaimer to get in here, but the point I want to make with this is all of the numbers that we show, even the policy that Stephen just showed, I mean, all of those are variable. It depends on your age, your health. There's all these underwriting criteria. So your specific situation may be a little different than what we're showing, and that's where having a call with our team, we can get into those individual specifics for you. But what I want to cover with everyone today is one, just go over, and I know this will be repetitive for some of the folks that have been with us for a while. For some of the new folks, I really want you to understand how a loan works because it's a little different animal than your mortgage or even a HELOC. Very similar to a HELOC, but it has a few differences to it. And then we'll discuss based on what you're using your own banking system for, when and how should the loan be repaid. So we're going to go through those different use cases. So stay tuned if you're a person interested in how to pay off debt. We're going to cover that. If you want to buy a major purchase, such as a car, we'll cover some of that. And we'll get into the investor mindset, and then we'll also talk about the supplemental retirement income. So the first thing I want to do is talk about these buckets, because Stephen shared with you this concept of premium deposits. And for most folks, when you put a amount of money into your bank account in the savings, do you feel good about that? Is that a bill, or is that like, hey, I'm saving some money? And I think most of you would say, hey, I feel good about putting money into savings because I'm saving money. All we're doing is we're saying, instead of putting it into the bankers, the traditional bankers bucket, we're going to put it in our bucket. So we're putting those premium deposits into our buckets. Now, the nice thing about this is those dollars are going to continue to grow uninterrupted compound interest for the rest of your life. So a lot of times I think about someone said to me the other day, I'm like, oh, I have $10,000. Should I just take that and throw it at my debts? I said, well, there's a short-term and a long-term answer. If you take that 10,000, throw at your debts, that money's gone forever. What if you took that $10,000, and here's a quick exercise, just take that 10,000, compounded at 3% for 5 years, for 10 years, for 15 years, for 20 years. That's the money that you lost in opportunity cost. I'm just using 3% as a very safe number. But the idea is that's the money that you're giving up over time when you just pay cash for things. So now we have this premium deposit bucket, and then we have this other thing called cash value ledger. And what I really mean by that is we all have seen a gas gauge on a car where we fill up our vehicle with gas, and then as we drive, it moves back to empty. Then we fill it back up with gas and it moves back to empty. That's what's going to happen to your cash value ledger as you take loans and pay back loans. Your available to use is going to increase when you pay back a loan. When you take a loan, it's going to decrease. And it's going to, so throughout your life of the policy, it's going to be going up and down, up and down, up and down. Now we have a death benefit with this whole life policy as well. And essentially the cash value is you having the ability to take some of that death benefit early. And also it's the collateral for your policies. So if you were to die with a loan, they'll just take it from your death benefit, pay out the rest. And then the last bucket is the really, really big bucket. If you look at the balance sheets of these insurance companies, they have a really, really big bucket called the Life Insurance Company's General Fund. When you take a loan, it's coming out of this yellow bucket. It's not coming out of your green bucket or your blue bucket or your red bucket. It's coming out of their actual yellow bucket. They can no longer go invest that in something else. So now what they're going to do is say, well, if you're leveraging some of that money, there's going to be some interest. Somebody asked, who gets the interest? Well, you'll see, stay tuned. I'm going to show you some of the math, but some of that interest goes back into this bucket, and some of that interest can also go into this green bucket, depending on how you're structuring your loans. So anyway, these are the main buckets we're dealing with a policy loan. Now, what happens if you log into your insurance company portal and you say, hey, I want to request a $10,000 loan? They're going to take money from that yellow bucket and dump it into your bank account. So now you have $10,000. Here's what they didn't do. They didn't ask you, what are you going to use it for? They didn't ask you, when are you paying it back? They just asked you, how much do you want? You said 10,000. That was available for you to take. So you take that $10,000 loan. All right. So now what happens when we do loan repayments? Let's say that you are a person who bought a car, and we're going to go through some examples. You bought a car, and now you're going to be an honest banker and just send that same amount of money back to your own bucket. So Steven, I know you said you buy some cars. I think you bought a Tesla not too long ago and maybe a new truck. But when you took a policy loan, did you be an honest banker and make payments back into your policy?
Yes. Yes, but not on a regimented regular monthly basis like I should.
Okay, so you're in control of when and how to pay it back, but you were making payments at certain periods of time,
Correct.
right? And so what was happening is Stephen would take the money out of his bank account and then it would go into the loan repayment. It goes into principal. So anytime you're paying loans back throughout the policy year, 100% of that goes to reduce principal. And then on the side, they're calculating the interest. So just like a HELOC, you're going to pay that down. You're going to lower your interest charge throughout the year. Now, at the policy anniversary, say a year later, say you start a policy a year later, you're going to have your policy anniversary. This is the time that the insurance company will say, you now have the ability to pay your loan interest. Do you want to pay it? And so if you do, you'll dump that loan interest. Or if you're not paying the loan interest, they're going to dump it into your principal for next year. So let's say we're cruising along, paying principal down. Into the policy anniversary comes and they say you have $500 of interest. What do you want to do with it? I don't want to pay it. Well, then they're just going to add it to your principal and you'll just keep on going. That's one option. Another option is you may just take some cash out of your bank account and pay the loan interest. So those are the two things you can do with loan interest. You can roll it into your principal for the next year, or you can just pay it. And I'm going to show you some of the math behind that. Let's talk about using infinite banking for debt pay down. I saw a lot of people said, hey, I've got some debts. I'm interested in getting rid of my debts. Before we do that, Stephen, is there any questions that came up during the last section we need to address live, or should we keep going?
Just keep rolling. I'm hitting the questions as they're
Okay.
coming.
So let's assume that you've got some debts, and those would be listed up in this box called third-party debts. This could be a credit card, could be multiple credit cards, car loans, student loans, medical debt. It doesn't matter. These are all your third-party debts. And what happens with your money flow is you've got income coming in, say monthly, from your job, maybe from investments, whatever it might be, retirement income. Some of that money is going up this path to pay for those third-party debts. Because if you have a car loan from a bank and you're not paying that car loan, they're going to come and get your car. So it's important that we continue to make those debt payments. At the same time, if you are going to use infinite banking for debt pay down, what we're doing is we're taking those monthly premiums or savings or deposits and we're running it into our specially designed whole life policy. So think of this. Let's say I've got $1,000 of payments going to debts. I have $1,000 that I'm considering my savings and I'm putting into my whole life policy so it compounds and grows for the rest of my life. Now, every quarter, you could do it monthly, but we just say every quarter, take the maximum loan and throw it at your third-party debts. So we're going to identify what is the debt we're going after, and we're just going to throw all of our money at that until that debt's gone, and then we're going to go to the next one and do the same thing, and then go to the next one and do the same thing. So with infinite banking, we have a flow of money going to debts. We have a flow of money going into our savings. We're leveraging that to pay down the debts. What happens when those debts are gone? Well, remember I said we had $1,000 going up this way to third-party debts. Now what we're doing is we're going to take that $1,000 and redirect it over into your own banking system. So instead of writing a check or sending money to Visa or MasterCard or whomever it is, you're now writing it to the bank of you. It's going back into your banking system to refill. Remember that cash value ledger bucket I was talking about, how the gas gauge goes up and down? Well, now you're filling the gas gauge back up because we want to be able to use this again. Now, I just want to share some things because some people say, what if I just did cash? What if I just threw the cash at the debts? That's great. You can do that. That's probably the short-term way to get rid of your debts. But unless you start building your own banking system, unless you start building your own financing system, guess where you're going to end right back up into? You're going to end up with third-party debts from Visa, MasterCard, the bank, all these different places because you didn't have a place to go get your own money to do the things you needed to do. So this is where I really want people to understand that we're taking a little bit more time to do it this way. But if you do this properly, you don't need to use Visa and MasterCard anymore to carry balances. Now I use Visa and MasterCard to swipe, 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 get the points, but I pay it off every month. I don't carry balances on any of that stuff. I don't want to have a bank balance with anybody. So those are the things that we're trying to get you to. I'm going to show you something called the vault, and we're going to run through a couple examples of loans. So step one, and Stephen, do you see the screen okay where it has the loan officer on it?
Yes.
Okay. So what we're going to do is run through a couple what ifs on policy loans. So you'll see here I'm planning to take a $10,000 loan. And let's just say it's at 5%. Do you remember in the slides how I said when you're dealing with interest, you can either add that to your balance at the policy anniversary or you can pay it off. Those are your two options. Any repayments to the loan throughout the policy year are 100% going to reduce principal. So now inside of the Vault tool that we're using, we can say, well, I want to just add my loan balance, my loan interest to my balance, or I'm going to pay it annually. And I'm going to show you the difference between those two. I haven't structured any payments, and there's a reason why. I just want to show you what happens if we take a $10,000 loan at 5% and we don't pay anything back. Let's go down to the payment structure here. So the first thing you're going to see is the ending balance each month. So at month one, we took a $10,000 loan, so our loan balance is $10,000. Month two, it's $10,000. Month 12, it's $10,000. So our principal balance didn't change because we never paid any loans back. We didn't put anything back towards our loan repayment. And then over here, you'll see the amount of interest that's accumulating. And this is where it's a little different than a HELOC, because in a HELOC, they will typically take that interest, put it on your balance, calculate interest, and then take that next interest payment, put it on your balance. With the insurance company, they're kind of setting it to the side. So let's say we get to our policy anniversary down here at month 12. Well, $10,000 at 5% is $500 of interest. Remember in my settings, I said I don't want to pay it. I want it added to my balance. So that's why we have $10,500 going back to our balance that next month. And then we start over calculating interest. So that would be one way that the loan works. Now let me show you something else here. Let's just say, well, what happens if I want to pay my interest annually? I'm still not making any other payments. So now we go down and we'll see interest still gets accumulated throughout the year. My principal balance remains 10,000. But now going into the next year, my balance remains 10,000 because I paid that $500 out of cash. So those are two different ways of dealing with interest. And what I typically recommend is just let the interest roll into the balance and make monthly payments. It just mathematically, it tends to work out better. And here's why. Let's say that out of $500, what's that, about $42 a month if I wanted to cover that on a monthly basis. So what I'm gonna do is I'm gonna come over here and say plan for just minimal interest. So it looks like I need 4167. So let's do payments of 4167 a month. So this is what we're going to pay back to our loan just to cover the interest. So I'm going to roll that I'm going to roll the interest into the balance. So hopefully everybody's with me right now, because all I'm trying to do is say, I just want to put enough in every month towards my principal so that when I get my balance going into year two, it didn't increase. I'm trying to keep it stable. So let's go look at the math. You'll see my principal balance keeps going down by 4167 every month. And as a result, my interest cost goes down as well. So instead of $500 at the end of the year, I owe $486 in interest. But by the time I put it back onto my principal loan, it's still, it didn't compound and grow on me. So I'm trying to keep my principal balance level where I'm not increasing the balance from year to year. Those are just some of the mechanics and the basics of the loans. So let me know if you have any questions on that, but I hope everyone kind of catches on to what's going on with the math there. Now, let's move into talking more about debt paydowns. All right, so here we are. We're in what's called the debt blaster, and here's a list of debts. Yours could be completely different, but in this particular profile, We have a personal credit card at $2,500 balance, rate of 24.9%. We're paying $75 a month on that. Business credit card, personal loan. So everything adds up to about $78,400 of debt. And we're making $1,265 of debt payments every month. Now, here's the thing. What if you're buried in debt and you don't have any extra cash flow? Well, what we want to do first is get your debts organized. And what I see most people doing is what's called the no strategy strategy. And the banks love the no strategy strategy because they keep you locked into the loans forever. So you may do refinancing, you may do balance transfers to 0% cards. You may be doing all these things, but if you don't bring some discipline and planning into your debt reduction, you're going to be stuck. And the other thing that I see a lot of folks doing is when they pay, say, this personal credit card off, they were paying $75 a month to that debt. But what they're doing is they're taking that $75 and running and buying more stuff or going out to eat. What we're trying to say is take that $75 and add it to the $125 and start throwing that at your business credit card. So let's scroll down to what's called the strategy comparison. And if you do the no strategy strategy with that set of debts, 181 months to pay off all that debt. And on top of that, you'll be paying over $30,000 in interest on top of the $78,000. So you'll be paying over $108,000 to get rid of all that debt. So what can we do? And if you haven't heard of snowball, avalanche, and cash flow index, those are what I call sequencing methodologies where you organize your debt. Snowball is lowest balance to highest balance. That methodology is not always the most mathematically advantageous, but what it does, it gives you some of those psychological quick wins of, hey, if I can pay off a $300 loan, I feel good because it's out of my life. The debt avalanche is looking at your debts from highest interest rate to lowest interest rate. It's oftentimes the most mathematically advantageous because we're getting rid of, we're keeping the interest cost as low as possible. So look at the interest compared to snowball versus avalanche. And then there's a third called cash flow index, which looks at the efficiencies of the debt, and it's calculated by taking the balance of a debt divided by its payment. And of course, the higher the payment you make on a debt, the more efficient it is. So cash flow index is all about organize your debts by efficiency. Now, I don't necessarily care if you say, hey, I want to do snowball or avalanche or cash flow index. Avalanche in this case is the most mathematically advantageous. But if you want to do snowball for that psychological win, then by all means go do it. But just do one of these. Don't do the no strategy strategy. Do one of these. All right. Now, what if we find out that you have some cash flow, or maybe you have a dump in and you want to use infinite banking? So this is where, let's just say, for example, you have $1,000 a month that you can put into a policy, and think of those premium deposits as your savings. So you're taking that $1,000 savings, putting it into your whole life policy, just like I showed in that diagram earlier. Although we're doing that every month, we're going to wait a quarter and then take the maximum loan. And guess what we're going to do with that maximum loan? We're going to throw it at this personal credit card. That's number one that we're going after. Then we're going to go after the business credit card, and then we're going to go after the personal loan. We're just going to do this until all of those debts are gone. So what I'm going to do is say, if I had a policy where I was putting $1,000 a month, I'm going to activate the cash value boost, which means I'm going to use that policy cash value to help me with my debts. All right, let's take a look at our strategy table. We've already talked about the no strategy strategy. We don't want to do that. Everybody let me know, put in the comments, I'm not going to do the no strategy strategy. Saying, you're not signing up for that. If you are, that's fine, but hell no, says Pete. I'm on board with you on that one, Pete. So then the avalanche would be mathematically the best thing to do. If you have no cash flow, I recommend at least doing this. If you have some cash flow and you have some savings that we can do, then we're going to go over to the infinite banking concept. Okay. So I'm glad to see all of you saying you're not doing the no strategy strategy. I'm really happy about that. So here's what's going to happen if you use infinite banking to pay down your debts. It's going to take you 44 months to pay off all those debts. Now, remember in this diagram, remember the picture where we're making debt payments, we're putting money into our policy, we're taking loans, throwing at the debts. And then once the debts are all gone, we're going to take that same debt payment and run it back into the policy. So here it is mathematically, 44 months, we're done with that line that goes directly to the debt. So we were paying $12.65 to those debts. After month 44, we're done doing that. We're no longer paying Visa, MasterCard, the bank, the credit cards, all that stuff, student loans. We now have a loan in our policy, and we're going to take that same $12.65 for the next 33 months and run that back into our policy. What's special about this? What's special about this time frame? If you have a car loan that you've moved into your policy and you don't make a payment, is anybody coming to repossess your car? If you have a policy loan that was from a car loan, is anybody coming to take your car if you don't make your car payment that month?
No.
No, but you want to be an honest banker and pay that back. And guess what else? All those debts, they're no longer public. They're in your policy. They're not on your credit report anymore. So would you want to get this number? Would you rather have this as 44 or 80? Would you rather get that stuff off your books in 80 months or 44 months? So now we're going to take that next 33 months and pay those loans back. So we're done with our loans and our debt payments in 77 months. Now, remember what I talked about is if you have cash and you just threw that $1,000 at your cat, you threw that $1,000 directly at the debts instead of running it through a policy and then throwing it. Guess what you don't have at the end of this debt cycle? You don't have the $74,000 of cash value, and you don't have a death benefit protecting your family of $325,000. Now, remember, I said all these numbers could be different with your specific situation, but in this example, wouldn't you rather build wealth while you're getting rid of your debts? Wouldn't you rather have a death benefit coming along for the ride to protect your family while you're paying down your debts? That's why we promote and talk so much about infinite banking, is because now I've got this $74,000, and guess what? Next time I need to borrow money for a car, I'm not going to the bank, I'm using this. If I have an emergency, I'm not going to swipe it on my credit card and pay for the next 3 years on 24%. I'm going to use this. If I have an opportunity that pops up, Steven calls me and says, "Hey, Craig, I've got this great opportunity." And, I look at it and I'm like, "Yeah, Steven, let's do it." And Steven's going to pay me 12% of my money. Maybe I take 50,000 out of here and I go do this deal with Steven and I make 12% on my money. So this is the kind of stuff that we're trying to get you to, as opposed to just paying your debts off and ending up at zero again. Because when you end up at zero again, you're ripe to be right back in the situation you just worked yourself out of. You're going to get back into debt because you don't have your own banking system. You don't have your own supply of cash to protect you from that. So that's the debt pay down strategy. Now, I'm not going to get into it, but there's also some possibilities of using velocity banking with this as well. Velocity banking brings speed. So you can tie debt avalanche, velocity banking, and infinite banking all to this together. And it's what I call the debt blaster trifecta, because we're bringing efficiency, speed, and wealth building into your debt pay downs. We'll move into, let's talk about buying a car. All right, so here's a couple things to think about. Let's say that, and I've actually done this with my own daughter. She bought her last car, was financed from the bank of dad, from our own family banking system. And all of the stuff I'm going to share with you, I did the exact same thing with her. All right, so let's say I'm Bucky Doe and my daughter's Minnie Doe. In my case, I'm not Bucky Doe, but my daughter did buy the car. So I'm going to loan my daughter $25,000, and maybe it's 6%, maybe my loan rate in my policy is 5%, maybe it's 7%. It doesn't really matter to me. I just don't care, because I'll show you why. What I'm going to do is take a $25,000 loan, say at 6%, and I'm going to loan that to my daughter, Minnie Doe, so she can go out and buy her car. Now we're going to structure this as a 60-month payment, which means I need to pay my policy back $483.32. So the first mathematical thing we want to talk about, am I really paying 6% interest to the insurance company if I take this loan and I pay myself back, or I pay my system back $483.32. Who thinks I'm paying 6%? Who thinks I'm paying less than 6%? Steve says no, less. You're right. Look down here, our base rate is 6%, but because we're paying our system back, every dollar is going in to reduce principal. we're reducing our interest cost. My effective interest rate of this loan is 2.96. That's just my own banking system. That's my internal bank. When I loan this $25,000 out, if I'm paying at least 483.32 back to my system, the insurance companies keep, getting that 2.96%. Now, what I'm not showing you here is my policy is also growing and compounding. So I'm going to be growing and compounding at a higher rate than this 2.96. So I've already made money in the banking system by borrowing from myself. But that's not where the story ends, because even though my policy might be 5.5 or 5.3 or 6.75, guess what? Minnie Doe is going to go out to a bank and she's going to say, what would you charge me if I had, what interest rate would you apply to my loan if I took out a $25,000 loan? Let's say Minnie Doe can get a loan for 7.5%. Well, guess what? Minnie Doe is going to pay this family banking system back at 7.5%. So over 60 months, she is going to make payments of $572.92 back to the family banking system. Now, I'll tell you, Minnie Doe says, well, Dad, if you get the money cheaper, why do I have to pay you 7.5%? That doesn't make any sense. I said, because we're going to treat our system just like the bank. You're going to treat our system just like you would with the bank. If the bank's going to charge you 7.5%, then the family system is going to charge you 7.5%. Because guess what? At the end of the day, when I'm graduated or move on, I'm out of here, this is all going to be theirs anyway. So why wouldn't you want to fund a system that you're going to benefit from? And guess what? Our family system is going to benefit $5,674.71 from just being our own bankings, just having our own banking system. This money would have otherwise left our system forever. This doesn't even include the compounding of the policy that we have. So when I show people this, the question is, why wouldn't we do this? Why wouldn't we do this? And oh, by the way, there's a death benefit covering the insured, myself and others, that, if something happens to us, is going to, be more than covering these loan costs. So why wouldn't you do it? So Darren's asking, will the vault keep this car loan to Minnie as a separate policy loan, or would it combine? That's a great question. And so let me just show you what that would look like. So now let's go to policy loan management, and you'll see down here, I have a loan from this policy that the purpose was a car loan for Minnie Doe. If I had another loan out here for, let's say, an opportunity, or maybe my own car, or an emergency fund, there'll be multiple loans from the policy that we can track individually. So now this is the fun part about it, is we can look at our family banking system and say, well, what is our available cash value? Remember the gas meter that I put on the cash value ledger bucket, where it goes up and down, up and down, up and down? Well, guess what? When we make a loan repayment, let's say that, she decides to make $1,000 payment, got a bonus, wants to accelerate her payment. It's going to reduce our balance, but it's also going to increase the amount of cash value that we have that we can use again. So if Steven comes back to me in 6 months and has another opportunity, and if I've built up enough cash value in my policy, I can take that out and go do my opportunity. So yes, you can track multiple loans differently inside of the vault. Now here's the other thing that I did for Minnie Doe. I actually did for my own daughter. So we did a promissory note. And let me show you where that comes from. So in the personal loan planning, we can click on generate a promissory note based on this loan that we just created. And I printed this off. I had her sign it. I signed it. So Minnie Doe was on the hook for $25,000 at 7.5%. Here's all the legal language. Now, between us and the family, I wasn't too concerned if it met all the Colorado state laws. But if you're doing this on a third party, you may want to take this to your attorney, have them look at it, make sure it adheres to all your state laws and everything's tidied up. But just for our family banking system, I do like to use these types of instruments just so there's a seriousness to it, because at the end of the day, this is a banking system and we need to pay it back. We're not going to be robbing from our own bank. So that's the car purchase. So we've covered debts. We've talked about car purchases. We do have an investment component coming back into the vault here, probably before the end of the year, but I don't have that built right now. So what I'm going to do is show you just kind of a diagram of how an investor may use the infinite banking process, and really how would we flow this money. So I know we had some folks out there that said they are investors. They use, they're looking for either doing real estate or, there's different people out there. It could be doing crypto, whatever it is. The important thing is whatever you're investing in should be something like, and understand. Now, Steven, Shauna, myself, Chris, I mean, we all love Private Money Club. We love doing private lending. There's a lot of different opportunities and deals out there. And what I'm going to show you is an opportunity where I'm putting money into a private money club opportunity. So we're lending money to a real estate investor, getting in first lien position. They're going to pay us 12% on our money. So how would that flow with an infinite banking policy? So step one, let's just say that we funded a policy where we put $100,000 in year one, and then every year we're going to put in 12,000. So I'm jumping you to year two because I want to capitalize this policy before I start investing with it. So in year one, I put $100,000 dump in, $12,000 of premium deposit. Year two, I'm putting in $12,000. So I have over $100,000 available to me to take out as a loan. So let's take that 100,000 from the policy. It needs to go into our segregated account. This is just a fancy word for another bank account that could be at your credit union that is going to be separate from our groceries and operations and gas money and all that stuff. So that $100,000 shows up in our bank account. Then we do our deal and we send our money over to the title company that's doing a closing or whatever it might be to get involved in this private money club deal. Now, this box could be, stocks, could be a Turo business. It doesn't matter what's in here. It's just the important thing is it's something that I can understand. It could be your business. But at the end of the day, we're going to have some gains. We're doing 12%. So now we have $12,000 of gains at the end of the year. What do we do with that? Option one would be, let's take that $12,000. I don't need it for retirement right now. I don't need it for income right now. I don't have a purpose for it. I don't want to reinvest it. So what if we just take that 12,000 and run it back in as a principal repayment for the year? That's cool. Let's do that. So what if we keep doing this for 7 years? Because we've kept that 100,000 out there working and we just keep running the 12,000 back into the policy loan, we're going to keep whittling away at our policy loan balance. Some people like doing it that way. Some people like doing the way I'm going to show you in a moment. But by year 7, we've put in 184,000. We have a net benefit of 244,000. That includes the cash value that we built up in the policy, plus the $100,000 we have in our investment, plus the gains we had that year. That totals up to 244,000. So our cumulative return in 7 years is 32.743%, and we have $1.8 million of death benefit. So this is just a system that is going to, you just keep running the money through it, building, and you're protected with that death benefit. But let's look at one more, year 10. By year 10, we've whittled this loan balance down to 33,000, plus we still have our 100,000 out there working. We now have 216 put in the system and 332,000 of net benefit. Now, there's others that say, well, Craig, I would rather just pay the loan interest and then take the rest in and reinvest it. And that's fine too. Let's see what that looks like. So what we're doing now is we're taking that 12,000. We're going to take just enough to pay the loan interest at the end of the year, but that 7,000 is going to go back in to the investment and go around the circle. Okay, so we're just going to keep running money. So instead of making a principal loan repayment, we're just going to put $5,000 towards the loan interest, reinvest the gains, and just keep running. So let me show you what year 7 looks like. So by year 7, well, we still have a $100,000 balance because we're not reducing that. We're just covering loan cost, but we're now building up our investment capital out here. We now have 144,000 working, generating $17,000. We're scraping off 5,000 to go back to policy loan interest, and we're going to reinvest 12,336 in the next year. So by year 10, if you remember, we had about 334,000 of net benefit. So this is a way to be a little more aggressive, build more cash flow into your system, because now we're generating 22,000 of gains, but we haven't really done much with our loan balance. So whether you want to do one or the other, I'm just simply showing you you have options when you take a policy loan. You put that money to work, you can cover loan principal only, or you can run it all back in and pay the loan down and keep your, just keep your investment kind of stable. So whether you want to do something one or the other or between, that's kind of how it will work with being an investor. Let's finish up with some retirement. So for those of you in retirement, so what we've done so far is we've talked about how
I guess,
policy loans.
Craig, actually, I guess there is a couple in the comments.
Okay, yeah, let's do it.
All right, guys, I'm missing some of the ones in the comments, but if you put in the Q&A, we won't miss them. But let me now that I see them. So Darren was saying, will the vault keep this car loan to mini as a separate policy loan, or would it combine all policy loans into one?
Yes, it will keep them separate, and we did cover that, but it will keep. So if you have a policy that has a car loan for your daughter, and then you have the same policy that might have a loan for your own car or maybe an emergency fund, it'll track those individually. So you have loan management one here, and then you have another, policy loan here. You have another policy loan here. So it'll keep track of all those individually for you.
And Craig, just to pipe in, and the reason why that is so helpful is because when you're at the insurance carrier, it's all just one amount, correct? So this
That is
is
correct.
your way to organize it. Without it, like in this fashion, it is just going to be one lump sum amount.
Yeah, exactly. And so when you log into your portal at one of the insurance companies, you're going to see just the total amount. And so what Sean is bringing up, which is a great insight, is this is at least helping you track those individual things. So if Minnie prepays her loan or goes faster, you know what's going on with that individual loan segment, if you will, and then you might have another loan that's being managed as well from that policy.
Very nice. Thank you for piping in, Shauna.
Yeah.
Let's see. This is a good one. Vonda said, does everyone that gets a policy have access to the vault?
So the Vault is a subscription system. So I highly encourage you, if you have policies and you want to be able to manage them and be able to be more effective as an infinite banker, that this is a tool that we built so you can do that. But it is through a subscription that you can get in there and use it.
Yeah, and when you're just getting started, though, your money mentor, that when you
Mhm.
schedule that call with your money mentor, the strategy call, they're going to use the vault to help you design and create the plan for your policy. So,
Mhm.
that's why I recommend the Zoom call or the video call. It's usually on Google Meets. Because that way your many mentor is going to share their screen and they can start showing you and building some of this out with you to solve. Because remember, that strategy call is designed to solve your money problem. Whether your money problem is debt, whether it's retirement, whether it's building wealth, we're going to help you solve that money problem. And so we're going to use this for you. And then for those of you that want to, be able to keep everything coordinated and tracked and perfectly in line like the vault does, you can subscribe for a few bucks a month
Yeah.
and get access to all that. So let's see. Chi Alfred said, so the family trust bank account needs to be in place for repayment. The trust will set the rules for borrowing the money. Is that right?
So the family trust bank account needs to be in place for repayment. So if you do have a trust, I mean, you can certainly operate out of that trust, but this is not requiring a trust. Um, but I definitely think whether you have a trust or you don't have a trust, you should set up those rules for your own banking system so that, just like with mini does, like here is your payment, here is your promissory note, here's your payment schedule. You really need to treat your system just like you would with a bank, and they're going to require you to make payments. Now, when, you say, how does Minnie pay me back, or how does my daughter actually pay me back? She sends me a Zelle every month. I get a Zelle payment, and then I just take that and put it back in the system. That could be different if, let's say, that she had her own policy and she borrowed it for her own needs. I happen to be the policy owner and I control everything. So she's paying me and then I'm putting it back into the policy. But as
All
far
right,
as
perfect.
Yeah, as far as the trust or doing it personally, I am a big believer you should have those rules and do the promissory note regardless, because you're just setting the ground rules for here's how our banking system works.
Yeah. Okay, cool. And then the last one here, they're just asking, how do we get the loans from the policy? Is it from a bank or a credit union regarding a car? And talking about buying a vehicle using BYOB. So how do those loans come out?
So when you have a policy at, say, Lafayette, One America, Mass Mutual, Guardian, whatever it's going to be, you will have access to the portal, the life insurance company's portal, and you can take loans from there. You can call them, you can send in forms. So essentially, what you're doing is you're requesting a loan from the insurance company based on your available cash value. So you just log into your portal, put in the loan request, get the money. They drop that right into your bank account, and then you can take that money and go buy your car.
Very good. All right, cool. That's perfect, Craig. Appreciate the
Okay.
answer to that stuff. And let's keep on rolling.
Yeah, so we've got just a few minutes left, so I'm just going to kind of run through real quickly the retirement piece. And just imagine, if you will, over the course of your life, you've paid down debts, you've financed cars for you, for your family, you took money out as we showed in the investment strategy, and you put that to work, you building cash flow. But now you're there at the point where you've got this policy, and I'm showing down here at the bottom, this is one of our older spreadsheets. Now that we have the vault, we don't necessarily do the spreadsheets anymore, but at age 55, let's say that you're done, you're ready to retire, but at 55, you're not really able to take money from your retirement accounts, your IRAs, your 401ks. You can't take your Social Security yet, but you have over $1 million of, let's say, cash value built up in your policy. And this is with putting $75,000 in year one, $25,000 for however many years, for 25 years. So now you've built up $1 million. We want to use that for supplemental retirement income. You have two paths, or you can kind of mix them when you want to start accessing this cash value for supplemental retirement income. You can start taking withdrawals. So I could say, you know what, I'm going to start just taking money as a withdrawal from the policy. So give me 25,000, give me 50,000, give me 35,000, and it'll start reducing your cash value. It'll start reducing your death benefit. I've run the numbers many times, but guess what? At the point where you're ready for retirement and you have a policy, we can run different scenarios to say, what if you do withdraw to cost basis? And what I mean by cost basis is, if you've put in 75,000, 25, all this money is available for you to take back out without any sort of taxable issues. As soon as you take the next dollar, it would be taxed. So that's why we will withdraw to cost basis and then switch to loans. So I'm just showing you some of the math between taking just a loan from the start, or if you take withdrawals to cost basis and then loans. Typically, if you're trying to maximize the amount of money you can take out of a policy, and you'll see the math here. With this one, we could take out about 20,000 of tax-free income for 40 years. That's pretty cool. And so what I did is I went into the insurance company's software as an agent. I can go in there and do these what ifs and say, how much can I take out for 40 years if I'm starting with that $1 million? And at age 121, at age 121, I didn't blow up the policy. I still have some death benefit to pay out to my family. They came back and said, well, $20,384 is about what you could take. Now that's going to vary based on actual dividends and whatnot over time, but this is a pretty close ballpark. And then I said, well, what if I took withdrawals to cost basis and I want to see the number for the next 40 years? Well, we go from 20,000 to 36,491. So I've been able to maximize my tax-free retirement income. But regardless, whichever path you want to take, we can run the numbers when you get there. But now you've got the ability to take out money from even a gap funding. So if I was 55 and I retired early, I can do this as a gap funding until I can get to my Social Security, until I can get to withdrawing from 401ks, TSPs, IRAs, whatever it's going to be. But here's one other thing. Have you heard of IRMA? And I don't remember exactly what IRMA stands for, but if you look at that, it's a calculation that the feds use for how much taxable income is going to be applied to your Social Security, as well as how much is going to be applied to your medical benefits and Medicare. This $36,491 doesn't even hit the record. It's not even part of that calculation. So one of the benefits of taking retirement income from a policy is that it doesn't impact your Social Security benefits. It doesn't impact the cost of your Medicare premiums. However, if you take money out of a 401k or you take money out of an IRA, that does impact those calculations. So this thing just has so many beautiful things. And again, we've used this policy all through our lives to finance things we need, to pay off debts, to cover emergencies, all of these beautiful things. And at this point, now we can use the policy for supplemental retirement income. We can use it or not. So one of the strategies Chris Naugle has taught on is what's called a volatility buffer, where maybe you're taking money out of your IRAs and then the market's down. Well, we don't want to take money out of our IRAs and 401ks when the market's down, except for our required minimums. So then we go over our policy and we supplement it. And then when the market's back up, we don't take it from our policy, we take it from our IRAs. So now you can kind of balance where's the best place to take your retirement income when the market's up or the market's down. So with all of that said, we're at our ending time and happy to address any other questions, but hopefully you've enjoyed the path of going from debts to financing major purchases to using opportunities to retirement and what this whole thing looks like. And really, how do we manage loans at each of those phases of how we're using the policies? So if you have any questions, shoot it over to us. And Diana, thank you for putting the IRMA in there. Appreciate that. I just couldn't remember what the acronym stood for, but it's a really, really important thing to know of and be aware of when you get to that retirement, because it's going to impact your benefits. So thank you so much, Diana, for sharing that with us. All right, Stephen. What else do we
Yeah,
have?
man. Good stuff. I got one question. We get this a lot, so I was just saving it to answer for everybody. But why does the death benefit go down after the seventh year, or whichever year?
Yeah, so let's talk about that. There's an IRS stipulation or regulation called the modified endowment contract, and the without getting into all the big whiz bang math behind it, the way I would describe this is the IRS is saying there's a certain amount of death benefit that's required for the amount of premium deposits you're putting into a policy. So they're trying to say, hey, if you put too much into a policy and there's not a corresponding death benefit, then you're taking advantage of this whole life tool for the tax benefit. So we're going to go ahead and tax you on it. There's a lot of history and details about that. But what do we do? So Steven shared a policy. What was that, like $100,000 dump in, 50,000 a year policy?
Yes.
And that death benefit dropped after year 7 or 10. But the reason that dropped is we had to put a term rider. So I see some folks, Marcia, you got it, Ernestine, you got it. There's a temporary term rider inside of the whole life policy that we put in there to satisfy the IRS MEC 7 calculation. When we don't need it, we're going to drop it. That's why you're seeing the death benefit going down typically at year 7. You're also seeing the costs that are associated with that going down. Now, I've had some folks where they'll say, hey, at the end of the day, I want that death benefit on longer for family protection reasons. There's nothing wrong with that. You could leave that 7-year term rider on for 10 years, for 15 years, for 20 years. There are some valid reasons to do that. But if we're just trying to short term keep that term rider on for just the bare minimum, that's typically where we drop it, is year 7.
Very good.
And Shirley also has another good point about, it deters money laundering as well. So there are some concerns out there, and we're always having to be listening for these. If someone shows up at our doorstep and, hey, Stephen, we're having a strategy call and I'm just very shady, and hey, how much money can I get in this policy, and how much can I get out right away, and I don't want to put any premiums in anymore. Our antenna might come up like, hey, there's something shady going on here. It could be a money laundering situation. So, we're trained and we deal with that stuff. Unfortunately, it does happen out there, but I'm not going to want a term rider in there if I'm trying to get a bunch of money in and out to launder it. So,
Yeah.
but
Very
anyway,
cool.
Great
Well,
stuff.
we're past our time here, so I'm gonna wrap this thing up. If you have any more questions, throw them in. We'll answer these last ones once I hit stop on the recording. And you guys can always join us every Wednesday, also at 4:30 Eastern, and a little under 2 hours from now on the Ask Me Anything happy hour, where our Money Mentor team does the Brady Bunch style on screen and just sits there for an hour and answers all of your questions. You can watch that on YouTube at the Chris Naugle or on our Facebook pages, so you can watch that live each Wednesday. But we really appreciate everybody being here. Now's the time for you to take action. So if this is starting to resonate with you, if you want to start exploring what this looks like for you in your personal situation, again, whether it's debt, whether it's purchases, whether it's like her mini over in the Q&A, which we'll answer in a minute, which she's looking at retirement and retirement planning. Our money mentors are going to use all of our experience, all of the tools that we have at our disposal to solve your money problem. You're going to see everything up front, exactly how everything works before you ever sign on any dotted line to actually put that policy in force. And remember, you're not paying us anything for any of this. We make our commissions by a reduced commission from the insurance company, just like any other agent out there. Craig, myself, our money mentor team, we're all licensed life insurance agents. That way we don't have to charge anything up front. We strategize with you. You're going to see everything, understand everything before you ever actually do put that thing in force and commit to it. And with that being said, get that strategy call scheduled, talk through it with your agent. We'll have as many conversations with you until you're comfortable to move forward with it. So no pressure at all right there, but we really appreciate everybody being on there. Craig, any last words?
No, I just really appreciate the involvement, everyone's questions and being plugged
Yeah,
in. So
great
hopefully this
engagement.
is all useful for everybody else. And Shauna, thank you for joining. Shauna just says things so clearly and right to the point. I just love it.
Yeah, pipe it in, pipe it in, pipe it in. Very good, Shauna. Thank you very much. And I hope everyone has a great day. We'll see you guys next Wednesday for another wealth webinar. Have a great one.